Hey everyone, Matthew Varga here. In today's video, I'm going to talk about refinancing a home. What exactly does that mean? Why might some people do it? And why it might be a good idea to refinance your home and use that equity to invest. Before we jump into today's video, make sure you give this video a big thumbs up. It really helps with the algorithm and getting this video in front of more people and more eyeballs so we can really grow this community. So let's start with explaining what exactly refinancing your home is. So refinancing your home is when you take an existing debt that you already have on your home, whether it be a mortgage or a line of credit, and you close that out and you replace it with a new debt. When you do a refinance, it can either be for the exact same amount as what you had before, or it could even be for a lower amount or even a higher amount. So you might be asking, why would anyone want to refinance their home? Well, some of the main reasons people do it is 1, to obtain a lower interest rate. 2, to shorten the term of their mortgage. 3, maybe you have a variable rate mortgage and you're looking to replace it with a fixed rate mortgage. Or number 4, to tap into existing equity that's accumulated in their home. So let's take a look at each of these reasons just a little bit further. So the first one was to obtain a lower interest rate. We're in a very low interest rate environment right now with interest rates less than 2% in a lot of cases, depending on the bank that you're working with. So if you would have gotten a mortgage a few years ago, you might have been paying anywhere between 3 to 5% in interest compared to the 2% that you can get today. So if you were to refinance your home today, you might even be able to cut your interest rate in half. So a lot of people have been going to their banks and looking to refinance to take advantage of these low interest rates that we have today. Now, one thing that you need to keep in mind is that if you are doing this, depending on the bank and how much longer you have on your mortgage left, you might be hit with some big penalties for closing out your mortgage early. So you definitely need to speak with your banker or your mortgage broker to see if it makes financial sense for you to do so. But just as an example, I had helped someone refinance one of their mortgages and they had a $30,000 penalty, which sounds really high. But by doing the refinance and going to a lower interest rate, they were actually saving almost $70,000 in interest payments with that. So for them, it made financial sense to pay the penalty and do the refinance. So with the low interest rates that we have today, some people are actually looking to refinance their mortgage so they can have their mortgage paid off a lot quicker. Just for a basic example, you might have started your mortgage off with a 30-year mortgage at a 5% interest rate a few years ago, but now that the rates are around 2%, you might be able to cut your mortgage down from 30 years down to 20 years, and your monthly payments would remain the same or pretty close to that. The reason for this is because your interest rate is a lot lower, a larger portion of your monthly payment is going to pay down that principal instead of going towards the interest. The other reason was switching from a variable rate mortgage to a fixed rate mortgage. So I know that we've gotten some variable rate mortgages that are extremely low. Like we have a variable rate mortgage that's at 1.4%, but obviously that's because interest rates are very low right now. So with most banks, you can actually switch from a variable rate to a fixed rate mortgage without a penalty. So this just allows us the option that if rates start to climb, we might want to lock in at a fixed rate mortgage. That way we don't have to be concerned about our interest rate going up and up and up. We can lock it in and just forget about it. And the final reason was tapping into the equity that's accumulated in your property. So I think this is one of the main reasons why people are refinancing their homes now. With the prices of houses just exploding over the last year, people have seen their homes go up by tens of thousands of dollars in a very short period of time. So by refinancing your home, you're able to take out some of that debt equity and use it for some more investment. So I definitely believe that by not refinancing and tapping into that equity, you could be missing out on a lot of great opportunities by using that money to invest with. Now on the flip side, it can be a recipe for disaster if you use that refinance to purchase cars and boats and furniture and trips and maybe other stuff that aren't investments. Now, if someone has bad money management skills or budgeting skills, I would probably recommend that you don't tap into the equity in your home and you just leave it there. That way you're not able to spend it and sort of waste it on things. You can at least leave it tied up there and it's safe. But if you do have a handle on your finances and money management, then using this equity in your home to make more investments, to compound your return, it's a great way to help bring you closer to financial freedom and early retirement. So for an example, one of our properties that we purchased for $350,000 a few years ago was recently appraised at $750,000. So with this property, we have an existing line of credit on it for $380,000 because I already did a refinance not too long ago to take out some equity to pay off for some renovations that we did. So when we look to see how much equity we can get access to, we would look at what the appraised value was, which was the $750,000. We would times that by 80% because that's the most that a bank is going to lend up to. And then we take away the $380,000 that we have owing, which gives us potential equity that we can take out of $220,000. So for us, we're looking to take out that $220,000 that we can use for more investments. And if we didn't do this, that $220,000 would just sort of be sitting there as debt equity, which is not something that we want to do. So once we get access to this $220,000, there's a few options that we're looking into to see how we're going to spend it. So one of the options that we're looking into is to use it towards growing a dividend stock portfolio. Another option we're looking into is using these funds to make a down payment on another 1 or 2 investment properties. That way we're going to be able to be collecting rent, making some cash flow on these new properties. Hopefully they'll go up in value as well, and we'll be getting that mortgage pay down. The other option that we're really considering is to use this money to private lend at about 10 to 15% interest rate to other real estate investors. So the thing we love about this strategy is that it's a really passive way to earn monthly income. Once we lend this money out to someone, we just sit back, we collect our monthly interest payments until that project is done, and then we get our capital back, and then we can lend it out again to someone else. So this is actually what we do with a lot of the investors who work with us. They lend the money to us, we pay them that monthly interest, and then at the end of the project, they get all their capital back. Now, I know some people watching this are gonna be thinking, but by doing this refinance, you're taking out more debt, and debt is bad. Yes, it's true. You are going to be having a higher debt amount because you are taking out more debt on this property. So for example, in this case, the debt we'd be taking out as a line of credit, we'd be paying about 3% interest. But if we're turning around and lending this out to someone else at 10 or 12% interest, that 7% interest that we're making above what we're paying is just pure profit. So just for a simple example, if we were to take out that $100,000 from this line of credit and we were to lend it out at 10%, we are going to have to pay that 3% interest for that line of credit for the money that we're borrowing. So in that case, it would work out to, we'd have $100,000 on the line of credit, we'd be paying our 3% interest, which is going to equal $3,000 a year in interest payments. So that's going to be $250 a month. But we're going to be loaning this money out at 10% interest. So we're going to make $10,000 in the year, which breaks down to roughly $833 a month. So our profit is going to be $7,000 a year or $583 a month. And that's only with $100,000. What if we were to do this with $200,000 or $500,000? So you can quickly see how the profit that you can make from this can easily replace your income and help get you closer to that financial independence. And one of the other benefits to doing this, if you're Canadian, is that by borrowing that money and using it for investments, the interest that you pay on that money is actually tax deductible. So it's a great incentive for doing this. Now, I'm not telling everyone to go out there and refinance their home and take out more debt. You know, it's not for everyone. Everyone has their own risk tolerance and what they're willing to do, and that's completely fine. The point of this video was just to give you some understanding of what refinancing is and how for some people it can be a great way to take out some equity, use for more investments, and get you closer to financial independence, retiring early, and just growing your net worth. If you have any questions or comments about this strategy, leave them down below and I'll be sure to answer you there. Make sure you give this video a big thumbs up, subscribe, share with some family and friends. And if there's any videos you want to see in the future about real estate or personal finance, leave a comment down below and I'll be sure to do that video for you guys. Thanks again for watching and I'll see you next week.